Now, before jumping into it, I want to let you know that Moomoo is giving away some free stocks right now. Moomoo is a free trading and investing app, and it does not accept payment for order flow, which after these last few years is definitely a good thing. Moomoo also has a social aspect integrated into it so that you can interact with other traders there on the platform. In fact, there are a lot of features that Moomoo has that you might not find anywhere else. By using my link down in the description, you could get up to 5 free stocks, each of them worth up to $3,500. Use the link and sign up, and Moomoo will give you 1 free stock. Then if you fund the account with any amount, you will get another free stock. And if you fund your account with $2,000, you'll get another 3 free stocks. Again, each of these stocks worth up to $3,500, so go use the link down in the description and claim your free stocks with Moomoo today. Hey everybody, Alex here. Now in today's video, I want to talk about a mistake that a lot of beginners in option trading might make. Now here's the thing with the option trading game. Now when you go into an options trade, you should always look mathematically at your probability of success or your probability that your option will expire in the money or out of the money. This is obviously very important because you want to know your chance of winning the trade, right? So a lot of the times when we're buying options, especially buying out of the money options, sometimes, especially in the beginning, you don't understand what your probability of that option actually becoming in the money and making money off of that trade, right? Because that is the ultimate goal when buying options. You want, if you're buying out of the money options, you want that option contract to become in the money, all right? And same thing when we're selling options. When we're selling options, we want to sell an option that is out of the money and then have that contract stay out of the money. Have that price, the strike price, not be reached by the stock, right? So we understand that. And once we understand the concept of what we want and don't want when we're buying or we're selling, we have to also understand the probability of that thing actually happening. And for that, we have to look at the probability of success. Another way to look at probability of success on a trade is to look at the probability of that option expiring in the money or out of the money. And the percentages are there on brokerages. On all brokerages, you're going to have probability of in the money and probability of out of the money. Now, when we're buying options, we want a higher chance of probability of in the money, right? Because we want our option contract to expire in the money by expiration date. When we are selling options, we want to take a look and make sure we have a high probability of that option being out of the money. Both of these in the money and out of the money probabilities add up to 100, right? So if you have an option contract with a 20% chance of expiring in the money, probability of in the money, then you will have an 80% chance that that option will expire out of the money. All right, and vice versa. So now we could start taking advantage of this by saying, okay, well, I'm an option seller, so I want a high probability that that option contract will expire out of the money. So we look for contracts that have the probability of out of the money right there stated, 80% chance that this will expire out of the money. All right, so now we have an 80% chance that this is going to win for us, that this is going to expire out of the money. We're going to collect all the premium and we go about our day. Happy, pappy. We look at that and then we look, okay, when we're buying options, I only have a 20% chance of this expiring in the money, right? So maybe we're not going to take on that trade. And maybe, and this is a lot of the times when you realize this, you say, oh, well, I don't have such a good chance of winning this trade, and I keep piling my money into buying options, and I keep losing my money. So now I'm going to transfer over my money to the selling option side to have a better chance of winning the option. So this is all step number 1 of what you have to get your head wrapped around, especially as a newbie. And this took me a while as well, because when I started option trading, it was during a bull market, and everybody's a genius at that point. And I would buy option contracts, and then when that bull market tended to fade, all of a sudden I'm like, how come I'm not winning anymore? And that is because obviously we have a lower chance when we're buying these out of the money contracts to make money. Okay, so that's the first thing that we have to understand. And then we have to understand that this probability that we're seeing in option contract is based off of the implied volatility move of the contract, right, itself. And one thing that I won't get into too much detail about here, but it's worth exploring, is that the actual volatility of a movement of a stock is always overstated by the implied volatility. In other words, if we have an implied volatility of 50%, and so the market is saying that that move will be 50%, the actual volatility of that doesn't reach the implied or what the market thinks the volatility will be, okay? So what that says is when you're just taking one trade and the implied volatility is X amount, the actual volatility will be lower than that. Now that's the first thing. Now the second thing that you want to keep in mind with the probability of success number that you see there is that this number, if you're only doing it over one occurrence or one trade or just a handful of trades, it won't be this exact number, right? So if you're saying 80% chance of happening, maybe you do 1, 2, 3 trades and you're going to lose those trades because you need a high number of trades or a high number of occurrences to happen for that probability of success or the probability of expiring in the money, out of the money, for it to be more of a real number to you. You need a lot of occurrences to happen so that when you average all of those occurrences out, that makes the probability of expiring in or out of the money more real, the number that you see on your option chain. So here's what I mean by that. Let's equate this to a coin flip, all right? You flip a coin, you obviously know you have a 50-50 chance of it expiring heads or tails, if it landing on heads or landing on tails. So I flip a coin, I know it's going to be 50-50 chance, right, of either or. But what happens if I flip a coin and it lands heads? And I flip a coin again, it lands heads again. And I could flip it 5 times in a row and it will land heads 5 times in a row. Does this mean that the actual probability is not 50-50? No, not at all, right? Because if I flip the coin 1,000 times, that average amount of heads and tails will be closer to the true probability of it happening, right? So it will go closer to 50-50 the more times you do it, right? This makes sense. So we could apply this to options in the same way. The more times that you put on a trade, right, the more it will go towards that real probability number. So if I only put a trade on once and it said 80% chance of probability that I'm going to win the trade and I don't win the trade, logic would say, especially as a beginner, oh, this probability thing doesn't work. But you have to realize that you have to do it over and over. And doing it over and over will get you more close to that real number of 80% chance that it will expire out of the money. I hope this makes sense so far so we can move into the third thing. Now, the third thing that we have to think about is, well, okay, if we realize that we take a look at the probability of success, all right, we understand that. 2, we take a look at, we need a lot of occurrences to happen to get close to that probability of success. Okay, fine. Well, you might be saying, well, Alex, I'm not made of money, right, to keep going and trading and just hope for the best over a long period of time. Well, nobody said that you have to put in all your money into one trade. So what do? And this is the most important thing of this whole strategy. You have to split up the amount of money that you're putting in to go over, to instead of putting everything in one trade and hoping that that 80% is right on that one occurrence, you want to split up your money into different occurrences over a long period of time, okay? So here's an example. If I had $10,000 to invest, instead of putting all my $10,000 at once in the beginning of the month and sell an option contract, instead of doing that, I would split that up within 10 trades, within the course of 2 weeks, let's say. So that might look something like this. Every day for 2 weeks, you're putting in $1,000. Now, this is going to do a few things. The first thing is it's going to break up your trades so that you're not putting everything in at once. And this way, you are going to be more likely to succeed and more likely to get to that percentage of success, right? But also what it's going to do, and this I think is even more important, is it's going to move your trades along with the market, right? So during that 2-week period, the market is moving, right? Up and down and up and down. And what happens if you put your $10,000 in right at the beginning? Well, you can lose on that trade, right? And lose money on that trade because all of a sudden, after the first week, now it's trading up here, right? Now the chart of it is away from where you started. Maybe you put on that trade when it's already too high of a price. Maybe you put on that trade when it's already too low of a price. So when you put on that trade initially, you're hoping that that was the perfect timing for that trade. But doing it this way and splitting up those $1,000 increments, you are moving along with the market. So the market goes up, then another $1,000 is put on at this point. And then the market goes down, and then another $1,000 is put on at this point. So this way you are putting trades along with the market moves. Very important to do. And again, from there, if we're selling options and we're selling 1 month out, then we're just taking 1 month out from when that trade occurs. Okay, makes sense. And then it also breaks up your increments into $1,000 increments in this example, and that will get you closer to your probability of success. And again, we are using the probability of success to start this whole thing off. And if we want to put that to a strategy, let's pretend we're doing iron condors, okay? Iron condors with $5, again, this is just an example, stock is trading at $100, and I'm selling an iron condor, and the strike prices are 105 on the high end and 95 on the low end. And now the stock moves to 103. Well, now I'm going to put another $1,000 in to an iron condor with a strike price of 108 on the high end and 198 on the low end, right? So this way you are putting on trades along with the market. You're not putting everything at once, and this will get you closer and closer to your probability of success, probability of expiring out of the money, collecting that premium, and this way you'll have more success. And this is something that a lot of people, especially in the beginning, don't necessarily think about, and I think you should, because this will make your chance of success even more likely to happen than just going off the probability of success alone, okay? So I hope this makes sense. Those are the 3 things that you should look for. Try it out. Don't put all your eggs into one basket, especially with things like iron condors and strangles and things like that. Split them up over time, and I think you will have a much better chance of success and much better understanding of this trading strategy. So hope you enjoy that. Give the video a like, share it with somebody who needs to learn about this. Thank you for watching, and we'll see you on the next one.